So we thought of getting you somebody who watches emerging markets in India very closely, sitting out of Singapore. I'm talking about my friend Rana Gupta, who's joining us from Singapore. He, of course, works for Manulife Mahindra Mutual Fund and very close watcher of India because his origin is India. He's an Indian by origin, but sitting out there away from the noise. Rana, afternoon. Thank you so much for chatting with us today. After a long time, we are having a conversation. What do you make? There is suddenly a heightened hopes that FIs will flock to Indian markets in hordes. Some early signs have happened, and that is the reason narrative that large caps are the best place to be next 6 to 8 months. Where do you stand on this thought process?
Good afternoon, Ajay. Thanks for having me on the show. Good to be back. Yes, I think that particular logic has some merit. You see that after the election results, the markets have been rallying. There are two reasons to it. I think the political uncertainty, whatever there was, I think has been alleviated to a large extent. Now, I think continuity of the government has become the base case, if that was keeping someone away. And secondly, also you have to understand that the worldwide, the view is now becoming that US Fed is more or less done with raising rates, and the markets are increasingly pricing in rate cuts next year. That overall, we think, has improved FPI sentiment. Now, FPI sentiment leading to this November, December, overall flow-wise wasn't that great. And that's why we have seen the large caps kind of underperform. If the FPIs come back in a measured way, then there are chances that some of this underperformance that we have seen from the large cap stocks could reverse. And within the large cap space, we do think that if the economic growth were to continue, which we believe it will, ultimately the corporate credit growth has to pick up. And if the economic growth is strong, the rate cut cycle will be shallow, so the margin decompression that the markets are fearing for banks shouldn't be as much. So therefore, net-net, I think the banks' valuation also pretty reasonable. So large cap, yes, and within large cap, we think banks, the private sector banks, are in a pretty good position.
Right. Rana, I want to understand, there's no doubt about the fact that prospects of earning prospects, superior growth prospects in India, and of course political stability now. But which part of the market in the large cap universe, if I were to also extend it to the, say, BSE top 100 companies, where are the undervalued or fairly valued pockets in your view?
See, let's start with the large cap first. And I do think the markets will remain by and large range bound. They will digest those gains. And that's how we have seen the market moving. They jump up, they digest gains, and then they move on. So therefore, I think getting the sectors right is very important. We just discussed about the bank sector, and they have underperformed because of the reasons we mentioned and how we think that could reverse sometime going into early next year. We were and we continue to be bullish on the power sector because we do think that the power sector is now going towards the deficit scenario. So therefore, the utilization of the current plants will be higher. The sectors will go up, and also we will see new ordering cycles. So therefore, the power equipment side, whether it is also including the renewable equipment, also include transmission equipment side, is somewhere that we like quite a bit. So that's the second part. Third part is, of course, we have been bullish on the digital space, and some of these companies have become large and large enough to become the largest in large cap side, particularly in the consumer tech side, and that is one sector which we continue to like. And the last but not the least, I think we have been bullish on manufacturing. And if you take a step back and look at the broad theme, this government, I think most of the economic policies have been more investment driven. So first, public infra picked up. Then now we are seeing even household buying of real estate has picked up. And the corporate sector, they are receiving the benefit because government is spending, household is spending. So corporate profits are growing. Corporate profits are now at 4.9% of GDP, which is one of the highest level in last about 10 years or so. The good part is corporate is reinvesting these profits. So therefore, to our mind, we are going to see a capex cycle. And therefore, the industrial side is also something that we like.
Rana, where do you see value or growth prospects much better in the power, or how are you exactly playing the power theme? Last 2 years have been very good for a lot of power utilities, renewables or legacy, even power financiers. There's one view they have run up a lot and are fairly valued, not very cheap. Other view is that they still have offer 5 to 7 year growth visibility. So one should get into it them nevertheless. Which part do you like most, and what do you think of this argument?
See, broadly, the power utility and the power finance companies, by and large, has gone up 50-60% this year, if not higher. So one should not expect that kind of return. But I think even if you were to argue that at 1.2, 1.3, or 1.5 times, depending on which company you're talking about, even if you argue that they are fairly valued for their 13, 14, 15% kind of ROE, our sense is that this ROE generation there is no downside to this ROE. This ROE is going to get stronger if anything. So at the very least, you can expect compounding. And if you get 15-16% compounding per year, in 5 years, you get double the return. So don't expect a 50-60% because that derating to re-rating has happened. But at the very least, you get the compounding at the rate of ROE on the power sector. But that's on the utility side. Where I think some sort of re-rating is still possible is clearly should be on the equipment side. Because equipment side, particularly on the transmission and distribution side, we do think in the cable space, in the transformer space, there are orders that can pick up, because once the generation order picks, then the transmission orders have to be given. So I think in the transmission distribution space, whether it's a power and cable and all those areas, there's some scope of valuation relating is still quite possible. Even if it's not possible, the earning growth there, the order book growth and the earning growth there is going to be quite strong.
Rana, I was just speaking with JCB India head, though the unlisted part, but just to get understanding of construction equipment, manufacturing, holding equipment for prospect, and he was just telling me that we are already third largest construction equipment market in the world, and will move to second largest in the next 5-7 years. But the part which struck me was that he was saying that we have a 20% growth visibility on exports. Similar argument is coming from companies like TRIL, TRIL, KEI, some of the transformer companies, APARs of the world, wire and cable. They're saying that there is a major manufacturing and industrial capex happening in Europe and US, and India will be the country to feed into that. How are you playing that theme, and are you also convinced on this argument?
No, we have been convinced on this argument for some time. But before commenting a sector specific, let's take a step back and let's look at the design of it, right? So, what Indian government did, in case where the Indian government is the buyer, right, whether it's a power, railways, and all this equipment, they made a local content mandatory. That means the import substitution has to happen, right? You cannot just import and sell. That was the first phase. That has already happened and ongoing and happening. The second phase where we are moving on to now is basically technology absorption. For example, if you talk to corporates, they will tell you that, okay, instead of making let's say the example of railways, only the coaches, we are now moving into, let's say, forged wheels making. We are moving into, let's say, some other systems, integrating. If you talk to the electronic manufacturer player, earlier they were just assembling. Now they will tell you, whereas we are moving to, the motive, maybe the packaging motive, maybe some companies talking about investing in outside facilities. So the second leg that we're going to see now is investing and deepening valuation within India. First, the import substitution gave the volume. Now that is giving these companies confidence to do value addition. And since there is a good consumer and good government demand, that gives you the volume to absorb those costs. That makes you pretty competitive in the Western markets. In any case, in the Western market, I think to do capex, to manpower, the costs are just not comparable with India. On the top of that, you have good volume, good fixed cost absorptions. So I think in some of those cases, the Indian exports is going to be competitive. That said, I want to again clarify that in our view, the first order beneficiaries will be import substitution. Then we're playing for deepening value addition, and then exports. Also, because we believe in 2024, global growth is going to slow a bit. But I think if one is taking a 3-year view, the export story is pretty much alive.
Interesting. Rana, how are you looking at some of the export-oriented or outward-facing spaces? Pharma has rebound because of factors in US getting lesser stringent and clearances happening and low valuation. IT, mixed feeling. How are you approaching these two areas?
Okay, that's a great question, because we can offer some insights out the way we view the sector. Let's start with IT. I think maybe in a past interaction we would have shared that we are from a stock perspective, they are great companies, but from a stock perspective, we are not very optimistic on the large cap IT services companies, and largely because of we said that the demand growth is a bit soft, and then there is technological disruption, so on and so forth. That being said, I think if you move to the ERD space, the ERD space is a different story altogether. I think ERD space is something where India, companies are gaining a lot of market share, and those companies are smaller. They can kind of reprogram, reorganize themselves according to the technology changes and all of it. So I think this ERD space whether it's coming from auto or industrial in the Western world, is also industrial spend. Mind you, this is not IT spend, this is industrial spend. And the companies who are geared to those kind of spend, which is a software for the industries, we are quite optimistic on them. So that's on IT. On the pharma side, again, we do not we are again great companies, but the stock level we are less optimistic on the large formulation and large generic companies. What happened in US is due to the supply demand mismatch, the US generic prices have gone up. So we like some of the pure generic players there, and some of those companies geared to those pure generic in US. But also it's not really export facing, but since we're talking about the healthcare sector, one sector in India we like, it's an India focused sector, is the hospitals. I think that is also one sector where I think it's a nice way to play the risk, the high income consumption and spend on healthcare trend.
Yes, that's correct. It's a very big beneficiary of upwardly mobile population in India, much more getting affluent people demanding standard services.
Yes.
And across the country, not only the metros. Earlier, it was just the metros where you got quality healthcare. Now, with smaller towns and mid-tier towns also getting much more affluent. So that's again a very big theme which is unfolding. Rana, thank you very much for joining us and sharing your thoughts on parts of the market and also the overall outlook. Always great to chat with you.
Thank you, Ajay. Nice to see you.